Hi, my name is Jim and I was retired. This video is going to be a follow-up to my last video on managing asset allocation across all my buckets. And I'm going to bring back my solo cups to represent my buckets. That last video talked about managing the asset allocations across my time buckets, the three buckets that represent the assets that I need for the next 3 years, the assets that I need for the next several years after that that produce income, and the assets that I won't need for a while that are mostly equities. Now, in this video, I'm going to talk about the other set of buckets, the taxable, the tax-deferred, and the tax-free buckets. And I'll show you a change to my spreadsheet that I'm using for managing allocations across my 3 tax buckets. Now I'll begin with the standard word of caution. I am not a financial professional. I have no extra initials after my name. So take this as entertaining ideas from one educated consumer to another. Always do your own due diligence and seek out a professional if you need it. Oh, and by the way, did you subscribe to this channel? The more subscriptions I get, the higher this will go up in the search results. To review, these solo cups are really buckets, and in this case, the set of buckets are the tax buckets. They include your taxable accounts, savings and brokerage accounts that face taxation every year. They include your tax-deferred, which for most of us in retirement is the largest bucket. And that's all your retirement savings, and the key word here is deferred. You've told the IRS that you're deferring taxes until you make withdrawals, and then you'll face taxes on ordinary income. And then the best bucket is the tax-free accounts, the Roth IRA and Roth 401k accounts. You've made contributions of after-tax dollars. You've paid the taxes up front, and for that reason, you can make withdrawals within rules through your retirement tax-free. Both your contributions and the earnings are tax-free. And now, let me show you a quick change that I've made to my spreadsheet to track the asset allocations across those tax buckets. And a little later in the video, I'll explain why that's a good idea for your financial health. In my last video on this subject, I talked about an easy method I've used to download data from my Quicken software, my Quicken for Mac, that allows me to track all of my accounts on a daily basis. And I can download that data and paste it here into a numbers spreadsheet in my case. But the principles that I'm applying here are very simple. You can do this in Excel or even Google Sheets. Numbers is the one that I have built into my operating system here, so it's the one I'm using. So I use that copy to clipboard function that I described in my last video, and I'll show it here. And I paste those values into this sheet called Quicken Values here. So here's the model data. And again, this is masked data. I've modified it to protect my privacy, but it applies. I haven't made any changes to the data since the last spreadsheet. It shows about $1 million in assets spread across all of my accounts. And it's the exact same data that I used last time. And I pasted it here. But I made some changes to clean this spreadsheet up and correct a couple errors that I found in creating a function to count the tax buckets. I discovered I couldn't get the 3 time buckets to match the 3 tax buckets in the totals. And I think that's because I was using a sum-if to add up the percentage weights. And I'll show that to you in a bit. But correcting that, I'll show you what I did and also how I added the functions to count the asset allocations by tax buckets. Let's take a look. Now, if you recall, the values from that Quicken sheet are pasted over into these two other sheets. And in this case, the allocations takes a look at all the market values, adds them up for the asset classes, and then assigns these asset mixtures into large cap or domestic bond to give you this pie sheet. And let me show you that formula. I'm going to edit the formula to show you what I did to this. And this allows you to sum if the column over here for asset class matches asset mixture. And then it adds up the values that it finds in this column. And that creates the sum-ifs. And on the 3 buckets sheet is where I've made the most changes to this workbook to allow me to look at both sets of buckets. And in this case, in the cleaned up version of the 3 buckets worksheet, I've eliminated the 3 columns and I've just replaced it with this time bucket column and assigned a number. And it's going to use the sum if to add up the market value of what's in each bucket. And then I've added a column here for tax bucket, for taxable, tax deferred, taxable, tax deferred, tax free. It's by account, so you can go through it pretty quickly. The one area that I had to change here was my Roth 401k assets are lumped in with my 401k in Quicken. And so I had to know that these are the assets that I'm mostly putting in my Roth 401k, and these are the assets that are in my 401k. Now, down here in the time buckets, it tallies, as we've discussed in the last video, pretty much the same way. But over here, I'm looking at the taxable, tax deferred, and tax free column. And I'm looking at, for instance, the CDs in the taxable accounts. So this adds up sum if the market values of the things that meet the following criteria, that it's got to have G72 CD and the asset class, and it has to have H64 taxable in the tax bucket column. That gives you this total here. Assigning the mixtures into their assets, and you have this down here, which then fuels the charts that are over here. Let me look at the new version of this. It shows you the assets across the 3 time buckets that I introduced in my last video. And now it shows you the asset allocations within the tax buckets too. And you can see that the taxable, tax deferred, and tax free have different asset allocations within them. Now, why is it important to have different asset allocations in your taxable, tax deferred, and tax free accounts? Well, if you can avoid unnecessary taxable income in your taxable account each year, that's better. Likewise, if you're going to have ordinary income coming out of your tax deferred account, then things that generate ordinary income would be better there. And in tax-free, you want things that are going to appreciate the most over time. And that kind of explains why I have international stock, small stock, and REITs in my tax-free account, and why I have mostly cash, CDs, a little bit of short-term bonds, and some large cap stocks. But why would I have large cap stocks in my brokerage account? They pay dividends. And have you seen the dividend rate for couples filing jointly with income less than $80,000? That's why I have some dividends there. Now, there are a lot of articles out there on the internet about asset location, not asset allocation, but asset location. It's also called tax diversification. If you look for those, you'll get many ideas on how to properly position your assets within the 3 tax buckets. There's this chart that I've found at the Boggleheads website that shows you a range of tax efficiency in investments, and it guides how to position your assets in the tax buckets based on tax efficiency. Here's a simpler way of thinking about it. If you expect a low yield but high tax efficiency, then leave it in your brokerage account. Likewise, if you expect a high yield with a lot of tax inefficiency, then put it in your tax-deferred or Roth accounts. It's in the middle, then tax-deferred is probably the best place for it. What assets do you hold in your Roth? Are you making this kind of determination about where your assets should be allocated across the three buckets? Let me know in the comments below. Hey, and be sure to like and subscribe to this account for more ideas on how to manage your forced early retirement. Thank you.